Hello there, welcome to My Finance Teacher. In this video we're going to have a look at our valuation for a couple of largest gold miners in the world, including Newmont and Barrick. This data is based on their Q4 2024 results. As usual in our model, we look at discounted per share value after all-in sustaining costs, long-term debts and taxes. And in our model, we only look at proven and probable reserve as well as half of measured and indicated resources, without taking into account any of the inferred resources, never mind any of further exploration success. So to the extent that the market price might actually correctly value some of the future potential success, the fundamental valuation presented here might be different. But as you see, we like to lean conservative here by looking at relatively more established reserves in the ground. And of course, the data that we plug into the valuation model includes the prices of gold, silver and copper, the amount of reserves and resources in the ground, the costs of extracting those reserves. We'll look at all-in sustaining costs, we'll look at long-term debts and taxes. Of course, we'll look at per share value with a discount rate of 5%, and we have a bit of a secret sauce on insider shares, as larger percentage held by insiders helps to align the incentives of the management with those of the regular shareholders. Starting with the gold price, as usual, we're going to look at three scenarios, with a balanced scenario plugging in the gold price of only $2,600. The conservative scenario plugs in the gold price of only $2,200, and the optimistic scenario plugs in the gold price of $3,000. As you see, even in our optimistic scenario, we are far from being overly optimistic. In fact, our optimistic price of $3,000 is pretty close to where the gold price is right now. Next, let's move on to the reserves and resources in the ground and the costs of extracting those reserves out of the ground. Newmont now shows over 132 million ounces of proven and probable reserves of gold, which have actually increased by 3 million ounces compared to the previous quarter. That is quite nice, partly because of this recategorization from M&I into P&P reserves. P&P reserves of silver are at over 530 million ounces, which have actually dropped. That's due to ongoing production, as well as Newmont divesting some of its assets, selling some of its assets. In one of my recent videos, we've talked about the sale of Eleanor, and what does that tell us about the sentiment towards the producing miners. As for copper reserves, Newmont has around 29.7 billion pounds of copper reserves. Moving on to the resources, they have 99 million ounces of M&I resources of gold, over 469 million ounces of M&I resources of silver, which have actually increased compared to the previous quarter by over 12 million ounces. And the M&I resources of copper have actually decreased down to about 31 billion pounds. That's for Newmont. As for Barrick, they have 89 million ounces of proven and probable reserves of gold, which have increased compared to the previous quarter by over 14 million. Again, mostly due to this recategorization, we see M&I resources dropped by 12 million. P&P reserves of silver are at 160 million ounces, which has decreased by 10 million ounces compared to the previous quarter, mostly due to the ongoing production. And the P&P reserves of copper are standing at 39.6 billion pounds, which has also increased. Again, a recategorization from M&I resources, currently standing at around 13.2 billion pounds. Next, looking at the costs of extracting those reserves out of the ground, we're looking at all-in sustaining costs. Those are higher for Newmont, so slightly higher leverage to gold price. All-in sustaining costs for Newmont are at $1,630 per ounce. That is according to the guidance for 2025, and the all-in sustaining costs compared to the previous quarter and also compared to the previous guidance for 2024 has increased by a whole $155 per ounce. The all-in sustaining costs for Barrick are at $1,510, which has also increased by $110. Next, Moving on to some other financials as well as time value of money. Newmont has decreased their long-term debt by over $1 billion, with the long-term debt currently standing at over $7.9 billion. That of course is a good sign. Number of shares outstanding has decreased by 10 million shares. It's now at 1.13 billion shares outstanding, with insiders holding slightly more compared to the previous quarter, holding 0.33% of those shares. Looking at Barrick, their long-term debt has actually increased by $460 million up to nearly $5.2 billion. And their number of shares outstanding has also increased a little bit by 20 million shares up to 1.73 billion shares. Insiders are holding slightly more than last quarter. That is a good sign. They're holding 0.87% of the shares outstanding. As for time value of money, I'm going to use a discount rate of 7%. Mining, of course, is a risky business, so perhaps this 7% discount rate isn't really high enough to reflect the risks. Let me know down in the comments below what sort of discount rate would you like to see. We might play around with the numbers and see how it affects our valuation. As for the average mine life, which is based on the annual production as per the guidance, mine life is over 23 years. For Newmont, that's only looking at proven and probable reserves in the ground. If you add just half of M&I resources, average mine life increases to about 32-33 years. As for Barrick, unfortunately their annual production has declined recently, as did Newmont's, by the way. Does that reflect on the quality of the management? Perhaps. Let me know down in the comments below. In one of the upcoming videos, we'll have a look at some of the other miners with perhaps outstanding quality of management and growing production. Coming back to Barrick, their average mine life is at 27 years, looking at proven and probable reserves in the ground. Adding just half of M&I resources extends the average mine life to nearly 43 years. For taxes, I try to keep this simple by simply assuming a flat tax rate of 25% for all of these miners. Cash doesn't actually enter into the calculations, but we do have a glance at it as an additional risk measurement. So Newmont has $3.6 billion in cash and Barrick has over $4 billion in cash. Next, before moving on to the most interesting part of this valuation, let me remind you to join us at myfinanceteacher.org, where we regularly publish the best uranium reports on the internet. I'm certain that uranium is gonna get hot over the next few years. Talking about energy, we've recently discussed a very intriguing cash cow, which is relatively affordable with a relatively small market cap. If you're interested in dividends and share buyback programs, you might find some interesting ideas at myfinanceteacher.org. And of course, perhaps one of our most interesting categories is this category of juniors in metals that are going to perform outstandingly well once the sentiment in the actual miners as well as the developers reflects what has been going on to the gold price itself. And talking about juniors, we've recently looked at some of the major developments with Nevada King. For all those details and much more, make sure to join us at myfinanceteacher.org. Moving on to the valuation though, let's start with our conservative valuation, where we plug in the gold price of only $2,200. And in this scenario, we're only looking at the proven and probable reserves in the ground, without including any of the measured and indicated resources, never mind inferred resources. As I mentioned earlier, there are factors that are not included into the model, such as jurisdiction quality as well as quality of the managers. But based on the actual resources in the ground and how costly is it to extract those resources in the ground, the numbers suggest that the conservative valuation for Newmont is over $33 and the conservative valuation for Barrick is around $21. Next, in our balanced scenario, we plug in the gold price of $2,600, and in this scenario we still look at only proven and probable reserves in the ground. which suggests a valuation of over $58 for Newmont and over $33 for Barrick. Perhaps once this issue with Mali is resolved, Barrick might actually catch up with some of its valuations in the ground. Time will tell. Moving on to the optimistic scenario, we plug in the gold price of $3,000, and in this scenario we look at the proven and probable reserves as well as only half of measured and indicated resources, never mind any of the inferred resources. And this, together with all the numbers discussed before, gives us the optimistic valuation of over $100 for Newmont and over $57 for Barrick. Are we actually going to see Newmont and Barrick get to these share prices? I do hope so, although nobody does know the future. If Newmont and Barrick get to these share prices, then some of these juniors that we discuss at myfinanceteacher.org are going to positively simply explode into the stratosphere, as such prices for Newmont and Barrick would simply indicate that the sentiment in miners versus the gold itself has finally risen enough versus a gold price of beyond $3,000. That is all for now. Let me know what you think about true value for Newmont and Barrick down in the comments below. Have a wonderful weekend. Bye bye.